In the stillness of dawn, the lights flicker on inside a modest building in Rockville, Maryland. There, a small team at CEVA, the American Semiconductor Design IP company, finalizes a quarterly report that would send ripples through investors worldwide. The headline figure looks ordinary: revenue of $25.7 million, a mild year-over-year decline. But the fine print is extraordinary. 13 new licensing agreements, 4 of them in edge AI processors, and 2 strategic partnerships with leading U.S. automotive manufacturers. And then the jaw-dropping figure. CEVA's intellectual property now lives inside more than 20 billion devices across the globe. Normally, such news would trigger excitement across the market. In the world of semiconductor IP, contracts are the lifeblood of future cash flows. Each signed agreement isn't just a deal, it's a seed planted for years of royalties. More licenses should mean more income. But this time, the numbers refused to make sense. Contracts soared to historic highs, yet revenue fell. The correlation that investors rely on simply broke. Why? No immediate explanation followed, and thus began CEVA's mystery. To understand it, one must first understand what CEVA actually sells. It doesn't sell chips, it sells the right to design them. CEVA's core business is the licensing of its IP, tiny architectures, mathematical algorithms, and circuit logic that live at the heart of modern electronics. Clients pay an upfront licensing fee to access these designs during their early engineering stages. That payment appears quickly on CEVA's books. But the larger prize, the royalties, come much later, only when the customer's product actually reaches mass production and begins shipping. This two-phase structure, license first, royalties later, creates the very time lag that defines the IP business. Under normal conditions, a rise in licensing activity foreshadows revenue growth within 2 to 3 quarters. But CEVA's most recent results broke that cycle. Licenses multiplied, yet royalty revenue did not follow. It wasn't just a delay, it was a disconnection. This is rare in the IP world. When it happens, it usually signals one of 2 things: either a temporary manufacturing delay by customers, or a deeper issue, such as clients choosing to replace the licensed technology before production. The first hypothesis, the delay, has logic behind it. Many of CEVA's clients operate in long-cycle industries like automotive electronics, 5G infrastructure, and IoT devices. Designs in these sectors can take years to reach production, especially when regulatory or integration testing is involved. If that's the case, CEVA's revenue shortfall is simply a matter of timing. Today's contracts may yet blossom into tomorrow's cash flow. But the second hypothesis carries a darker undertone. In the semiconductor IP world, it's not uncommon for companies to sign contracts for technology evaluation, only to later pivot to in-house designs. When that happens, the license remains in the books, but royalties never materialize. Could CEVA's record number of deals hide a wave of non-royalty evaluations? That question now hangs in the air, unanswered. To probe deeper, one must look at the technology itself. CEVA's portfolio is vast, spanning the most advanced frontiers of digital design. Its flagship NeuPro-M processor powers edge AI, bringing machine learning inference directly onto the device, eliminating the need for cloud data centers. Its SensePro 2 architecture fuses video, audio, and motion data into unified signal processing, enabling real-time perception in vehicles and robotics. The Riviera Waves line encompasses wireless connectivity, Bluetooth, Wi-Fi, and ultra-wideband (UWB). UWB in particular is key to modern automotive innovation. It enables secure digital car keys and centimeter-accurate location tracking. Normally, new wireless standards take more than 3 years to gain acceptance in the auto industry's safety-first environment. Yet CEVA's UWB IP has already entered commercial design stages. That kind of acceleration is not just fast, it's unprecedented. It hints at structural change. Then there's the Pena G2, designed for 5G RedCap, reduced capability IoT devices, and the Pena G RAN, supporting Open RAN base station architectures. These technologies extend CEVA's reach into the communications infrastructure itself, a domain once dominated by giants. Taken together, CEVA's IP portfolio forms a full-stack ecosystem. AI computation, wireless connectivity, sensor fusion, and telecom backbone, all under one roof. Given this breadth, the financial contradiction grows even more puzzling. By all logic, CEVA should be reaping the benefits of cross-sector integration and long-term customer stickiness. Instead, it's reporting lower revenue at the peak of its technological influence. This disconnect between potential and performance is the essence of CEVA's mystery, and investors can't ignore it. Some clues emerge from leadership changes. In January 2023, CEVA appointed Amir Panush as CEO, a veteran of InvenSense with deep expertise in sensors and embedded AI. Soon after taking the helm, he sold off the company's design services subsidiary, Intrinsics, to Cadence. It was a clear strategic pivot, from operational breadth to financial depth. Panush signaled that CEVA would no longer chase every adjacent market, but would instead refine its core IP engine. And then, in Q2 2025, the company made a notable move, a 300,000 share buyback. Corporate buybacks are rarely random. They are a statement, a declaration that management believes the stock is undervalued. When insiders buy, it's because they expect future growth that outsiders can't yet see. Still, one question refuses to fade. How can a company with so many contracts, so much innovation, and such a vast installed base, 20 billion devices, report falling revenue? The answer likely lies in the intangible mechanics of the IP business itself, the delay between invention and monetization. CEVA's story is not one of failure, but of misalignment between engineering time and accounting time. Technology advances quickly, money arrives slowly, and that invisible distance between the two, the velocity of conversion from design to cash, is now the single most critical factor determining CEVA's true value. In this story, the mystery is not about products or patents, it's about time. The rate at which CEVA's promises transform into tangible dollars will define its next chapter. When the next quarterly report arrives, investors will finally see whether this lag was a pause before acceleration or the first signal of a deeper stall. Until then, CEVA's numbers whisper a riddle to the market. How fast can innovation become profit? The ValueStir channel invites you, our viewers, to share tips on public, private, or pre-IPO stocks and cryptocurrency projects that deserve a closer look. Leave your thoughts in the comments. We might turn your idea into our next deep dive feature. And to all of you who continue to watch, subscribe, like, comment, and share our videos, thank you for helping this community grow. This was ValueStir.